Welcome to part 2 of our two-part series on the subject of property valuation. In the first episode, we discussed the valuation process and its impact on your real estate investment. We dug into why valuation is important for real estate investors and how it impacts your investment. In this part, we are going to be discussing valuation as relates to the different approaches used to arrive at property values. We'll be talking about the different valuation methods and how these are determined in arriving at property values. Okay, so we understand that property valuation is the process in which a valuer conducts independent market research to accurately determine the value of a property at a specific point in time. Okay, so valuation is a process by which a valuer conducts independent market research to determine the value of a property at a specific point in time. Okay, property valuation is more an art than an exact science. It's not. It doesn't produce the same results every single time. Why is that? Because the property market is an imperfect one. Each property is unique on the basis of its zoning, its utility, its location, etc., etc. So you won't get the same results with every property you work with or work on. Each property might give you a different result depending on the value, utility, zoning, and desirability of that particular property. Moving on from there, we will look at property value itself. Property value isn't as clearly defined as other economic goods. Property value is not as clearly defined as other economic goods. These might be goods such as cars, electrical appliances, what have you. Several different forms of property value exist on the property market. Okay, and in the process of this discussion, we'll be looking at why that is, and gain an appreciation of why there are several different values to property. What are some of these different values that you might come into in the business of real estate? Number one would be your asset value. Okay, asset value is simply the value of an income generating activity. Asset rather. So the asset value is the value of an income generating activity. Second one would be the book value, which is the value of an asset or property as entered in your in the company's financial books. Okay, so that would be the book value of a piece of real estate. In addition to that, you have the fair value. The fair value is basically a reasonable estimate of what a property would fetch in the market. Okay, going concern value is the value of a property including its operating costs. So a going concern value is the value of a property including its operating costs. In addition to that, you have the investment value. The investment value is the value of a property in relation to an investor's unique financial objectives. I'll give you an example on this particular one. If you have a residential property in an area that could be rezoned commercial, for instance, and a commercial investor approaches you to acquire that property, you're not particularly keen on selling it, it's not on the market, you're not looking for a buyer or anything of the sort. But that particular investor thinks that location will be prime for that investor and they approach you for it. They offer you a certain sum, to acquire that property. That value is the investment value of that property to said investor. All right. And then you have the market value. The market value is just the expected price of a property on the open market. Okay, so the price a property is expected to fetch on the open market would be the market value. And then you have the residual value. The residual value is a value of a property after depreciation at the end of its useful life. So, at the end of a property's useful life, after depreciation, that value is called the residual value. That's not all, but those are some of the values you will come into in the business of property, unlike other economic goods. All right, moving on. The roles of valuers. What are the roles of valuers? Property valuers have several different roles. Key amongst those are the following. The first one would be determining the type of value the client is requesting. This is so to guide them, this is useful in guiding them at arriving at an accurate valuation of the property based on its intended use. Okay, so as discussed foregoing, you have several different values for several different reasons. Sometimes you're doing it for investment purposes, other times you're doing it for finance acquisition purposes, other times yet you're doing it for insurance purposes, and so on and so forth. So the valuer has the task of finding out from their client what the valuation is meant to achieve, and on the basis of that guidance, then coming up with an accurate valuation for that property's intended use. Okay. The valuer must also have a good understanding of the macro and microeconomic environment of factors influencing the property market. There are several different macro and micro economic factors influencing the property market. Inflation, for instance, is one of them. Your social and political climate is one of them. Climate, environmental factors as well is another. What is the environment like for investment in that particular area or jurisdiction? Is the political climate stable enough to sustain investments over the long term? What is the economic situation like at that particular time or over a given horizon? Okay. Now, what are some of the instances requiring property valuation? What are some of the instances requiring property valuation? There's several different instances in which valuation reports or valuation would be necessary. Top amongst those, of course, is the buying and selling of real estate. Second one is for insurance purposes. A third one, of course, is securing financing. A fourth is determining fixed assets for your, balance sheets or income statements and what have you for a business. You will need valuation of your assets when you're producing or providing such reports. Okay, moving on from there, the final bit on the subject is the actual valuation approaches. What are the different valuation approaches or methods in the business of real estate? Number one is the cost approach. Okay, so the cost approach basically is estimating the cost of construction of a given piece of real estate and then using that estimation as a guide for what a similar piece of real estate would cost on another site. Okay, I will say that again. The construction, the cost approach to property valuation is basically where you estimate the cost of construction of a piece of real estate, and on the basis of that estimation, then guiding you to estimate what a similar property would cost on a different site. That, in a nutshell, is the cost approach. The cost approach is not very commonly used because of so many inherent weaknesses in it. One of them basically is the unreliability of the method. Construction estimates can be notoriously inaccurate based on different factors. Sometimes the cost of inputs vary from time to time. Contractors will also charge you different rates for the same construction, depending on the contractor you used, amongst other reasons, market volatility, and so on and so on. Market conditions in the property market change from time to time. Okay, the second one would be the income capitalization approach. The income capitalization approach basically is when you look at a property's income generating ability. Okay, this is used in the absence of comparable properties to benchmark against. This approach is more commonly used in the commercial real estate market, for things like office buildings or shopping centers or malls, apartment buildings, and so on and so forth. So this approach is where you use a property's income generating ability to then estimate its value. Okay, and you do so basically by having a look at its net operating income, which is your revenue minus your expenses, and then dividing that by the property's capitalization rate or cap rate to arrive at the value. Okay, so that is the second approach to property valuation. The third and final one would be the comparable market analysis approach. It's also sometimes referred to as the sales approach. The comparable market analysis approach is where you look at properties of a given, of similar size, physical condition, and location to the property in question, and then using their value to reasonably assess the property in question's value. Okay, I will say that again. The comparable market analysis method or the sales approach is where you look at a property and then you look at other properties of a similar size, physical features, and location, okay, to a property in question. And based on those comparable properties' value, you then determine the value of the property you are looking at. That is the comparable market analysis approach or the sales approach. This approach is more commonly used in the case of residential properties. Okay, so this approach is more commonly used in the case of residential properties. For residential properties, you might not, many would-be sellers or buyers largely don't enlist the services of a valuer. It would be enough sometimes to just consult your realtor, and based on their understanding of the market or properties in that particular area, would be able to guide you as to the would-be value of your property. Okay, so those are the three main or major valuation approaches or methods in the business of real estate, and these help or guide in helping you determine the value of your property. It could be residential, it could be industrial or commercial real estate. Okay, just a quick recap before we go. Why is property valuation important? It's because it's the basis on which transactions in real estate happen. Those transactions might include, but wouldn't necessarily be limited to, the buying and selling of property, the insurance of property, securing financing for properties, or determining of your fixed assets for your income statements or balance sheets for your businesses. Okay, property values are not the same as other economic goods. They are often different, and these might vary depending on the particular objective of the valuation, and those values might include, the asset value, the book value, the fair value, the residual value, market value, and investment value, amongst others. Okay, and then finally, what are some of the approaches to property valuation? Some of the approaches to property valuation are the cost approach or the cost estimation approach, the income capitalization approach, and finally, the comparable market analysis or sales approach. Okay, so this would wrap up the second of our two-part series on the subject of property valuation. We'd like to thank you for your continued viewership and support. If you haven't subscribed already, would invite you to hit the subscribe button and help us spread the word by sharing this content. Thank you very much and see you on the next episode.